Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and Senior Portfolio Manager at McNichol & Associates Asset Management. First, I do wish to thank everyone who emailed me with their best wishes for my surgery last Friday. Unfortunately, after waiting in the hospital for more than 6 hours, it had to be canceled and will now take place on Monday instead. I'll be showing up next Friday with a cast in my hand, but otherwise it'll be business as usual next week. Well, it's an ill wind that does not blow some good somewhere, and the Silicon Valley Bank catastrophe has, at least for the moment, created a hope that the Fed's interest rate hikes will be a thing of the past, and that the bailout of the depositors of any and all threatened U.S. banks is a precursor to monetary easing. In the past year, a belief has somehow and mysteriously arisen that rising interest rates equals falling tech stocks, and falling rates, therefore, must mean rising tech stocks. The hope, and yes, conviction, that inflation has peaked and rates should now be easing is therefore leading to the corollary that a certain amount of Fed stimulus can start again. This has now been powerfully fortified by the failure of Silicon Valley Bank, which seemingly now absolutely requires a cessation of interest rate increases and, of course, flooding the money system with money to keep things afloat. Listen, all this may well become true, but I would like to hear it from the horse's mouth, Mr. Powell himself, rather than secondhand and perhaps quite erroneous suppositions by people who are basing their projections on their own portfolio positions. As we should know somewhat better next week when Mr. Powell actually tells us what's on his mind. At this juncture, I would be prepared to be cautious until he can clear the air. At least I hope that he clears the air. However, wouldn't you know, the high-tech stocks led by the FANGs have been on fire in the past few days, regardless of recent earnings and business results. At the same time, the indices with the value stocks, the Dow 30, the TSX in particular, but including the broader S&P 500, have all been on the weaker side. My responsibility to you is not to pontificate in what I hope or believe to be the actual case, whatever that may be, but to assess what is actually happening and recommend what looks to be the proper course of action as far as the FANG stocks are concerned. So, with the admonition that almost nothing that occurred in the past week was, I believe, forecastable, let's take a look at what did occur and what signals to investors have been given. I do continue to observe that we need to see the Standard & Poor's breaking out over its super growth price before I would become broadly bullish. And until then, I would have to label what has occurred recently as just another market rally within a broad bear market framework. Anyway, let's take a close look and see what the FANGs are trying to tell us today, if anything. But before we take a close look at those FANGs and what has been going on, as always, I do like to say thanks to everyone who likes this video and all our subscribers. It really helps to grow our channel, and we appreciate it greatly. Okay, let's start off with Meta. And, Meta, we had a nice buy signal on Meta, and rather than stopping at the super growth price, which is 3.5 times book, and forcing us to make a decision, the stocks simply jumped over it. and has been holding there nicely, and in fact has been quite strong recently. What are investors playing for? Well, of course, Zuckerberg has promised he's going to buy back stock and improve the earnings of the company by not wasting it on whatever, and therefore get that nice earnings trend back on track, in which case maybe we can see those kinds of valuations again. At least I think that that's what the market is playing for. Netflix, after our sell and perfect hit at the bubble price, has dropped one breakpoint to the mid super growth price. That's 5.5 times book value, and is having a nice little rally. And one thing you see here is that when you are playing some of these stocks, you have to be crisp and precise with your decisions. You have to watch these stocks carefully, and when they get to those breakpoints, you have to act, because otherwise you're probably going to miss 8 or 9 or 10% of whatever bounce is coming. NVIDIA has a look at that. We have a sort of a, I wouldn't say a conflict between standard technical analysis and SVA, but NVIDIA sort of formed a kind of a consolidation pattern just underneath its HB5 and has now broken out. So, of course, as we did when it broke out over its HB4, which is 20 times earnings, we might expect a breakout and a pullback here. So if you have been watching the stock and have not moved, maybe wait for that breakout pullback to see if this thing is actually going to go another breakpoint. And remember, sometime I showed you that the HB6 price, that's 33 times book value, the HB6 price, was the long-term low that went all the way back to the year 2000. Tesla, after a lovely, 2 3/4 breakpoint bounce, kind of rolled over and has now broken below its HB2, that's 12 times book value, has broken down and checked back dutifully, like a good technical signal should be, and has been now starting to move back again. I am concerned, particularly when I take a look at the fair market value of the stock, which is some 60% below the current price. I am concerned that there is more to go on the downside. Amazon had a absolutely perfect hit right at its bubble price and has been setting back. Now, I've been looking for it to get back to at least its mid-super growth price. That's 5.5 times book value, which is its long-term low, going all the way back in the entire history of the stock. What's going to happen there, I don't know. But when I look at the trend of the fair market value, I am not terribly encouraged that that may be enough. However, let's not prejudge events, but let's see what happens when they get there. Alphabet, like it did the last time that when it was trying to decide what to do at its mid-super growth price, that's 5.5 times book value, was swinging back and forth, indecisive or sloppy trading, and it's been doing it again. Well, very recently, in all this excitement about lower interest rates and further stimulus, the stock has broken out again. Frankly, I'll believe it when I see it. Now, the same thing is occurring with Microsoft. But one thing that I wanted to show you and remind you about Microsoft was this isn't the first time that Microsoft has exhibited sloppy trading at a breakpoint. It did 3 years ago around its HB2, which is, that's 12 times book value. And finally, what happened here is the stock actually broke out, and instead of pulling back under, it held. In fact, it bounced there twice, giving us a beautiful buy signal preparatory to the move to the HB3. Now, it's going to be interesting to see whether that will happen again, but that's what you need to watch for here. Finally, Apple. I really don't know what to say about Apple here. It's a stock that concerns me a great deal, not the least of which because it's very, very expensive, has a huge downside risk, and which may be trying to break through its possible HB6 price there. If I extend that there, maybe that's what it's been trying to do. I don't know, but when a lot of the other FANGs have been exhibiting considerable strength recently, Apple has been just sort of dithering. Doesn't give me a great deal of confidence about the downside risks here. Now, to sum up, if you recall my words 2 weeks ago, I asked what we had seen that week. I said that I usually like to ask, what have we learned? But I'm not sure that we have learned a thing, as far as I can tell, except that the growth stocks, as exemplified by some of the FANGs at least, are happy to accept the fact of peak and now falling interest rates, regardless of any established reality. Indeed, after a burst of enthusiasm this morning, the FANGs closed on a cautious note. Now, Meta is holding strongly above its super growth price. That's 3.5 times book value, and our buy signal remains intact. The stock acted very well today. Second, following our recent sell at my bubble price target, Netflix fell right to its MSG price. That's 5.5 times book, and is having a nice little pop. For anyone who is very fleet of foot, and I mean fleet of foot, there was a possible trade into the shares here for maybe a 10 or 15% bounce, maybe even more. But for the investors in the crowd, I'm not optimistic that the setback from the bubble price is over and done. Nvidia, I have to say, surprisingly, looks as if it is trying to head even higher and could be breaking out over its HB5 price. That's 26 times book. If you look closely at the trading, when the stock cleared its HB4, it had the usual technician's breakout and test of the breakout point. So perhaps we're on the verge of even higher prices. Now, Tesla, in contrast, and contrary to the general optimism for the rest of the NASDAQ stocks, looks as if it is having a confirmed technical breakdown below its HB2 price, or 12 times book. Amazon rallied a bit, but as far as I can tell, continues to slip back to its MSG price, 5.5 times book. It's very long-term low. But the still falling fair market value measure does not necessarily promise support there. We'll have to wait to see how the market reacts at that point, as it will then be at the lowest valuation for Amazon that it has ever fallen to. Alphabet and Microsoft have both been dithering on either side of their recent breakpoints for some time, what I refer to as indecisive or sloppy trading. Both, however, have recently broken out on the upside, although I would not necessarily characterize this as all positive. Here's what would catch my attention, however, and here's what you should be watching for. And this is a big if one or both of these stocks break higher and then tests the breakout point and holds, then the breakout can be real. I know that it has been 3 years since Microsoft did exactly that, as I reminded you today. But this Copilot program using ChatGPT to essentially integrate everything sounds as if it could be a real earth-shattering breakthrough. Finally, I've never called for a sell on Apple, but now that we have a new balance sheet, Apple increasingly appears to be letting go below its guesstimated HB6 price at 33 times book, an indifferent fourth quarter, and a 43% downside risk. Its intrinsic value does speak volumes to me, asking, what is this stock doing this high? I would personally not hold anything that looks like such weak long-term value. And I have to say that the SVA work remains very uncertain. I'd like to finish off by reminding you that unless or until the Standard & Poor's is actually able to break out over its super growth price, or 3.5 times book, which seems very unlikely now, I would treat any exposure to the NASDAQ stocks with considerable caution. Anyway, for now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I will see you next week.